Welcome to Freeman on Real Estate, the podcast about the hard facts behind what's going on in real estate. Realtor Mike Freeman of Coldwell Banker, who holds an MBA in finance, draws from his financial background and deep network to bring the most value for anyone looking to buy, sell, rent, or invest. Hello, everyone. Welcome back to Freeman on Real Estate. This is David Yaz, the Boston Podcast Network in our Westwood, Mass. studios. Here again with, of course, Realtor Mike Freeman. Mike, it's been a little while. How are you?
Yeah, it has. I guess the last time was summer, and we needed the AC, and now it's, it's a little more comfortable out there, right?
A little bit, yeah. Crisp in the air. I know you must have an extra lilt in your step because I know you're a big New England Patriots fan.
And great.
Happy days are here again, at least for the moment.
Yeah, first place.
Can you believe it?
It's not like it's been 2 games; it's been 6.
I know.
Yeah, so I've been good. Good beginning to the fall. How about you?
Yeah, not bad. Still kicking. You know what? My kids are happy and healthy. The end. Right?
There you go.
That's all you need.
Yep.
As we do, we welcome professionals to this pod, ones that are trusted advisors or trusted professionals in whatever they do. And I know Mike has another great one here today. So without further ado, would you like to introduce our guest, Mike?
Yeah, so I'm really looking forward to this conversation I'll be having with Nancy Levine from Mortgage Equity Partners. So welcome, Nancy.
Thank you so much.
Great to have you here. Anyway, so Nancy and I are part of the same networking group, just for full disclosure, at the Neponset River Regional Chamber in Norwood. So I've had a couple of other people on this show who are from that group. If anyone is looking for a networking group, we have a fantastic group. And either Nancy or I would love to talk to you about it. So, Nancy, we've known each other for a while now, and we've done a bunch of deals together.
Yes, we have.
And you've been great to work with. So what I want to start with is, if I think about a new client for me, a new client for you, somebody who maybe it's their first time buying a house and they don't know, maybe they're a doctor or a lawyer or a construction worker, and they're really bright, but they don't know anything about this. They've never been involved in the housing market. So could you talk a little bit about how you work with that person and how you explain to them that the economy plays a role in interest rates?
Sure. So when I meet a new customer, I will go over how rates work with the economy, and I explain how we look at the 10-year treasury. It's the best benchmark. The 10-year treasury is about 2.25 spread from rates. So when they're asking me about rates, I can say if you follow along with the 10-year treasury, you can get an idea where rates, the general ballpark. And then I'll go through what changes rates, how we look for the first Friday of every month is the jobs report that gets released. If it's a good job report, rates could get worse. If it's a good job report, rates will get worse. If it's a bad job report, rates improve. So I tell them the first Friday of the month is important. And then throughout the month, we look at inflation numbers because inflation is the arch enemy of mortgage rates.
Right. So let's suppose someone is like, okay, Nancy, I really like the way you explain that. But one thing I don't understand is why would good news for the economy result in a decline in interest rates, which I want? But why is that? That sounds like it's counterintuitive. Why is that?
Well, the bad news that people are pulling money out of the stock market and putting it into the bond market from fear, because the markets they measure fear.
Absolutely, yeah. So that's what we find. Both of us find. Nancy sees it more than I do. But if there's if there's high inflation, if unemployment is high, things are bad for the economy, then that is going to result in people, most likely, it's a rule of thumb,
right,
they're going to be going from stocks to bonds. And bond prices, not to get too much into it, but bond prices move inversely with interest rates. So it's a good thing for people to think about that if people are buying bonds or bond funds, the interest rates are going lower. That's good if you're buying a mortgage. So worse economic news means lower interest rates, which are better.
Right.
Okay? I have that right?
Yes.
Okay, good.
And then the other thing, too, is I'll tell them, if you're watching the stock market, if it's a good day in the stock market, typically it's it's not a good day in the bond market.
Right.
And that affects our rates. So it's a seesaw.
Rates will typically go up in that instance, which
Correct.
is not good for people. Yeah.
No, they want to hear low rates. That's what they're used to.
So the opposite is really what people are looking for. You really
Correct.
want bad economic news, which seems counterintuitive, but that's what you're looking for if you remember nothing else.
Correct.
So you mentioned the 10-year T-bond, Treasury bond. So why the 10-year versus, say, the 3-month, the 30-year? Is there a reason why that's the primary thing you look at?
Yeah, so it's a good benchmark because the average mortgage lasts between 7 and 10 years.
Yeah, that's what I find too. And if I don't have a smart mortgage person who's going to explain things like Nancy is, and sometimes people have their own mortgage person and they don't explain things as well as you do. And so, you know, that's where I'll want to come in and explain it to them like that's the average length of a mortgage. And it's, and we've seen over time that I don't have the numbers in front of me, but if you looked at the average length somebody holds a mortgage 10 years ago, 20 years ago versus now, it's definitely gotten even less.
Right.
But the 10-year Treasury bond is still what people use as a measure.
Yeah, it's the benchmark.
Yeah. So how much time would you say, you talked about what you look at during the month. So how much time would you say you spend during the course of a month looking at economic news and then seeing how that relates to the interest rates that your customers are going to have to pay?
Great question. I actually subscribe to a service that I follow every day. There's a video every morning talking about the day's events and what reports are coming out. So I follow that, and I keep track of the 10-year as well. So I keep a chart, and then I can look back and see where rates are and where the 10-year was to compare.
Yep.
But the service that I have, it lets me know what the market's doing. I get texts 4 times a day. There's alerts if the rates get worse. There's alerts if the rates improve, which is great. And they just have a lot of information. It's a great resource for me. And I follow the experts because I'm not an expert in the economy. So I follow the experts and I learn from them. And then I pass that information to my clients. And
I get that information too. You pass it to the realtors you work with because I get, I believe, a weekly email from you with economic news, and it's very comprehensive. Sometimes what I get because everyone puts you on the mailing list, right? So unfortunately, I have to disclose, Nancy, that I do get updates from other lenders.
It's okay.
But theirs, it's not usually as comprehensive as yours.
I think that's good to know.
Yeah, so it really gives me a good understanding of all the different factors. So, okay, so here's the ultimate question. I know this is what people are thinking, and you know what I'm going to say, and I know the answer is it depends. It depends on a lot of different factors, and I'll let you. So actually, why don't I let you talk about it? So if somebody says, at the beginning of a conversation, so Nancy, what's your rate?
Right.
How do you, obviously there's no one answer. So how do you handle that?
Right. There's no one answer for that question. Basically, what I have to do is ask 26 questions to figure out what the rate's going to be. Yes, because rate equals risk. The higher the risk, the higher the rate. So credit score, the type of property, are they showing, is it a bank statement loan? Is it a full doc loan? There's just so many questions that we have to ask. So I just can't give a blanket rate. Is it a 30-year fixed, a 15-year? Is it an adjustable, jumbo, FHA, conventional? There's just so many questions.
It's all those things. It's the type of loan, and then it's the type of credit risk that person is.
Right.
Yeah, exactly. So what are rates right now? No, I'm joking.
Can't tell.
I'm joking.
It's also, too, like the type of property. Is it a condo? Is it a single family? Is it a multifamily? Is it an investment? Is it a second home?
So I'm going to try to narrow it down a little bit.
Okay.
And I know you hate this. I would, too. So let's suppose you're somebody with 750 or so credit score. It's a single-family home. It's in Greater Boston. They're going to put down 20%, so they're not going to have PMI, private mortgage insurance. Mm-hmm. Is that enough to give you? I know that you would sit down and ask the 26 questions, but let's just say that's kind of the profile of the person.
That's good credit.
That's good.
It's going to be really good. Probably the top level.
So in the mid sixes for someone like that?
Mm-hmm.
Okay. So
depends on the day and the time.
Right. But we're somewhere around 6.5%. And we were, I would
A
say,
little bit less too. I
a
mean,
little bit less. Okay.
Could be.
So at the low point, we were at 3 or even a little below, right?
correct.
So we're still about double, a little more than double that. But we're lower than we were.
Right, but if you look at that 40-year average, we're still below the 40-year average.
Absolutely. And that's actually what was going to be my next question. So if you look at, so in the last, since rates went up from 3%, which was what, like 3-4 years ago?
Correct.
What's the highest rate, or what would you say how high did rates go in the last few years? 8?
Yeah,
Yeah.
mid-8s.
And so we're already down. We're already down in the low 6s, which is great. But you're right. Historically, if you look at the last 40 years, I mean, my parents' first mortgage was probably 15, 18%, right? I mean, people had like even 20, right?
Yeah, like in the 80s, I think they were like 16%.
Yeah.
The 1980s.
Then Reagan came in and everything got better. we won't get into politics. But no, interest rates came way down in the 80s and after that. So I think that's important for people to know, that you look at, people are out there. I meet people every day who are looking for houses, and they always want to know where interest rates are, and they're always trying to predict where they're going to be. But it's sort of like predicting what a stock's going to do, or a bond's going to do, or what home prices are going to do. And they all fall into that same category where I tell people, don't try to time the market. Don't try to be smarter than everybody else and think that you can, you have a crystal ball and you can figure out. Nobody knows.
Nobody knows.
We don't know if a year from now rates are going to be 8 or if they're going to be 5.
Right. We just look to see what the experts are predicting and see what they think.
Yeah, the so-called experts, right?
The so-called experts. But then the other thing that I do as well with the rates is that I just try to show payments. I take that rate and I show, this is what the payment looks like.
Yeah.
So that's more concrete. They can understand, like, oh, that's what my monthly payment's going to be.
Exactly. That is a much better way for people to think about it, because a rate alone, what does that tell them? And one thing that I do, and I'm going to give Nancy credit here. So a lot of my customers know that I've created a financial model that helps them understand, if they're looking to buy and sell at the same time, it allows them to very quickly and simply look at the major factors and determine what the results are, what can they afford. And one thing that Nancy really helped with is closing costs. So I'm like, okay, how much is title insurance? I don't know. I mean, I know about what an attorney charges, but
Right.
there's some things that are formulas.
Correct.
So, so let's just talk about one.
Okay.
Okay, so talk about title insurance, and because that's one of the that's probably the most expensive one, right?
Right.
So if you're buying a home, you're most like there's title. Well, why don't I let you talk about it? Go
so
ahead.
there's lender's title insurance and owner's title insurance. Lenders you have to have. Owners is optional, but it's really good to have it.
Right.
Protects the customer.
And how much does this cost them?
So there's a formula. Did you want me to tell you the formula?
I mean, yeah. Okay.
So
it's like so many dollars per thousand,
it's like
right?
$4 per thousand. Because if they're doing a simultaneous policy, they're getting lenders and owners. It's like you take 4% of the purchase price, add $175, and then for the lenders, you take the loan amount times by like 2.65%, and then you subtract that from the original number I told you.
So the typical person, ballpark, is looking $2,000 or $3,000 in title insurance. Is that right?
Yeah, because I'm just trying to think. I just had a loan that closed as a $600,000 purchase price, 3.5% down, and the title insurance is probably like a little under $2,000.
Yeah. So that's what I want people to come away with is, since that's your biggest closing cost, it's bigger than your attorneys, your recording fees, a lot of other things. $2,000 to $3,000 is the typical amount, and then you have to figure out as a buyer, how do you want to pay for that? And we won't get into it here, but there's all different options. But it's not free to buy a house. It costs money.
It's expensive.
A lot of people think it's just the cost of the house and how much money you're putting down, but it's a lot more than that.
Right, and other fees keep going up as too. Every year goes by,
Yes.
the fees get a little bit higher.
They do. So let me ask you one other question, and then we'll go to the more about section. But
Okay.
I want to ask you, how would you say that, what are some ways that you differentiate yourself? I know you've done a lot of different things in your
Sure.
experience. So can you talk a little bit about that?
So what I always tell people, I can't control the rates, but I can control how I operate. And I always try to get back to people as soon as possible. I try to give them a clear, concise information so they understand what's going on. I always let them know that I'm always a phone call away, that if I tell them something, if they're not going to remember it, they can ask me 20 times because I work with this every day and they don't. So they really appreciate that. I also try to write out information and make everything clear, just so they can follow along as well. I'll always follow up with information so they can look at it, review it, and call me.
And how about the different things that you've done in the business over your career and how that's benefited you?
So I've been in the business for 33 years. The first 10 years I was in operations. So I was closing. I worked in the escrow department. I was a processor, a junior underwriter, a sales assistant. So I know how everything works from top to bottom. So when I take an application, I actually know really like the whole industry of what the underwriters are looking for. I pretty much know a really full good application.
And that's exactly what I was thinking. And one of the advantages that I have found in working with you, like knowing the entire process and all the different areas of applying for a mortgage, and the fact that you've been in operations and now you're in sales
for 20 years.
Yeah, I mean, it really helps because you have that broad-based knowledge that a lot of people don't. A lot of people don't understand how the back office works, how operates, but it's important.
It's very important, and it makes it easier that the inside staff appreciate what I do.
Yeah. And what about your company, Mortgage Equity Partners? I'll give you a little bit of time to give them a commercial. So what do you like about your company?
They're a great company to work for.
Yeah.
The people are great. They care about the loan officers. It's just a great company. They give us a lot of tools that we can use to help us grow our business.
Okay, great. Okay, well, I think at this point, I will pass it back to Dave to do the more about section.
Yes, let's get into it. It's more about Mike. It's also more about the guest.
More about Mike.
More about Mike.
More about Mike.
More about Mike, but also more about Nancy. So we're going to spin the wheel and come up with a question. All right. And today's question is, if you had a time machine, what would you do with it? If you had a time machine, what would you do with it? So you can go back in time. You can go forward in time, far back or as far forward as you like. Nancy, you're the guest. Would you like to go first?
Sure.
Okay.
So with the time machine, I think I would like to go back. I think I like to go back when I was a kid.
Mm-hmm.
It was just fun, just very innocent times and fun times. Also, a lot of my relatives have now passed away, and I would just love to see them again and to be with them in family parties. And I just miss all of that. It's hard as you get older when you lose people.
Of course. Where did you grow up?
In Canton.
Okay, I grew up in Sharon, right,
close by,
right
neighbors.
across. Yes,
Yeah.
exactly. A lot of fond memories of going up to Cobb's Corner, and
Yep.
I don't know. I'm trying to remember what we might remember fondly from Cobb's
I
Corner.
remember like the candy store.
Yeah. Candy Delight.
Candy Delight.
Yeah. Candy was great. The place was like a dream. The guy who ran it was a little bit of a jerk, I remember, but whatever.
What about the bowling alley?
We had a bowling alley. Yeah, Canton Lanes.
Yep.
Yeah.
Used to go
There was
there.
a Burger King next to it there for a little while.
There was.
It was a big deal when Burger King moved in there, I remember.
Because of the McDonald's?
No, just because there wasn't a McDonald's at the time.
Yeah, there
I don't
wasn't
think
McDonald's,
so.
no.
Right, but I don't know. We felt honored that a Burger King was so close to where we lived. Well, that's a nice thought. We need now the time machine. Technically, if we're doing the DeLorean and Back to the Future and the time machine, you'd be going back. You could talk to your relatives, but it would be you from 2025.
That's
now,
pretty cool.
would you like to be you from 19 whatever?
No, I think now, today.
Okay.
Because you know so much more.
Okay. Yeah, that would be cool. And you can
Yeah.
impress people. And then, like
Yeah.
Mike, I could go back and find young Mike Freeman and tell you the winners of all the World Series from, 1978 to 2025.
With the sports almanac?
Yeah, exactly. We don't want to
Sports almanac?
we don't want to go all biff on us. Yeah. All right. We've waited long enough to hear Mike's answer to this question. What are you going to do with the time machine?
So I really like Nancy's answer, and mine is somewhat similar. So I'd probably go back a couple of 100 years, and I think about that scene in Back to the Future when Marty McFly meets his relatives with the first ones to come over from the old country, from Ireland.
Yeah, they got the Irish brogue or
Yeah.
the some kind of Cockney accent, I think. Yeah.
So I'd like to go back to, I mean, the different sides of my family came over at different times, but I'd like to go back to like the late 1800s and meet great grandparents that I never knew, and I'd want to be me at about this age. I don't know, within the last 10 years, and just be able to talk to them about, what they're thinking about and coming over to this country, and why do they want to do that? Like, it'd just be really cool, and also to see that how different everything looked. Like, can you imagine what Boston would look like?
Yeah. Or any of the places we're familiar with, right? Yeah, it's and you think that we have it so much better now with technology and everything else. There was a TV show about it was James Franco was in it, and he was going back in time, basically to thwart the Kennedy assassination or something like that. But the point of my story is he would go back. When he came back, he said the 50s or I guess it was early 60s, right? Early 60s, like. You go to a diner, everything tastes so good. And I thought about it. I'm like, yeah, that's probably right, because they didn't there weren't as many preservatives, so they had to serve everything fresh. So yeah, how'd you like to go back and get like a nice, burger and fries in a soda pop, or a shake or something at the local, Brigham's or something.
Yeah,
pretty cool.
For the fraps.
Right. Yeah, but yeah, I could see you going back to the 1800s and finding out. Grandpappy, Fillmore Freeman, who's like he's in real estate, but he's selling like log cabins and stuff.
Yeah, exactly.
That's awesome.
Exactly.
Yeah. Well, terrific answers for both you on more about Mike. And Nancy, could you tell our listeners how they could get in touch with you if they want to learn more about what you do?
Sure. My contact information, again, Nancy Levine. My cell phone is 781-608-7220, or my email, nlevine@meploans.com.
Very good. And Mike, please remind our listeners once again how they get in touch with you.
Sure. So my phone is 617-759-1513. Email mike.freeman@nemoves.com. And also you can check out my website, mikefreemanhomes.com.
Very good. We thank you for tuning into the podcast. If you're listening on the audio version, you should know that there's a version on it. This will be on YouTube, right, Mike?
That's right.
Yeah, okay. It'll be on YouTube. Check that out. Please subscribe/follow to the podcast wherever you find your pods. And we thank you for listening to Freeman on Real Estate.